All right, what's up, everyone? I wanted to do an update on the technical analysis that we've been doing on US 2-year yields, and this is government bonds, 2 years. I figured it would be a pretty good time to do a little bit of an update, considering we had the FOMC meeting today with Jerome Powell and the Federal Reserve. So basically, the Fed came out and they really didn't say all that much. But considering the last meeting was pretty hawkish, not saying all that much, in my perspective, was actually pretty hawkish. I think there's a lot of people that are looking at it as a dovish event, but in my eyes, I think it was still harboring a hawkish atmosphere. So, because they're still talking about tapering, and I believe they're announcing that they're planning on being done with tapering at the beginning of March, which is, February, March. So considering we're at the end of January, that's a little over a month away. So we have a lot of tapering that's going to occur in the next month. When this happened in 2013, we had a taper tantrum. Now that it's happening, we've already had a big taper tantrum, and tapering hasn't even started. And I would argue that the move that we've had in yields isn't necessarily due 100% to what's going on with the Federal Reserve and what they're announcing at their FOMC meetings. There have been a lot of regulation adjustments back in 2021 that would support the move that we had in yields. If you consider the exemptions to the supplementary leverage ratio and the expiration of those, which happened April 1st of 2021, that basically means that depository institutions and primary dealers, more specifically, can't really take on any more TLE, total leverage exposure, which means that they're not going to really have the opportunity to help out too much with purchasing any of these treasuries or bonds or really any sort of fixed income. The Federal Reserve has been buying up a pretty good portion of the supply that's been hitting the auctions over the last year. As they begin to taper their purchasing, they're not going to be there to provide liquidity to the market anymore. So in my opinion, there's definitely a strong chance we're going to get a supply-demand imbalance when it comes to the treasury market once again. So basically, I think that's why the environment supports stronger yields at the moment, especially considering how the Fed has been acting over the last couple meetings, and why I consider this meeting to also be a hawkish event rather than dovish. And I think if we look at the charts, the markets are agreeing. And we have right here, as I mentioned, the US 2-year yields. So let's take a look at the chart. You can see that we have this blue line up here. This is going to be our trend line dating all the way back to the late 80s. You can see we've touched it once, twice, 3 times, 4 times, and for a 5th time more recently. So this would include 89, 95, 2000, 2008, and 2018. But one of the main reasons why I think this line represents a period of potential pressure for the economy is that this blue line up here is actually higher than it is on the US 10-year chart, which suggests that as we get up to this blue line on both charts is when we typically get a inversion of the yield curve. I think that that's probably going to be somewhere that it's likely to occur this time around also, due to the same reasons. And we are getting pretty close to that. The delta on the short end is definitely quite a bit higher than the long end. So if things were to continue playing out how they are at the moment, that would be the outcome that we find ourselves in. We would find ourselves up around this trend line with a lot of pressure from yields, with an inversion in the yield curve, which typically predicts a recession about a month out. Sorry, I meant to say a year out. What I was thinking about saying after that was that typically a month after we get a yield curve inversion is when the Fed likes to switch course on its policies. So as soon as we get that yield curve inversion, if the Fed hasn't already switched courses, give it a month out, and as long as the curve stays inverted, they have actually come out and said that that is their point of reversal. So I would expect them to hold true to their word and use that as a pivot point also. So worst case scenario, somewhere up around this blue line is likely when we're going to get a pivot in Fed policy response due to that. And that's worst case scenario. I think there's a pretty good chance that Biden's numbers start tanking even faster as we have not only inflation, but a crashing economy to go with it. That's going to be pretty bad for him. So, a lot of the reason why the Federal Reserve is taking this inflation so seriously as of recent is because of politicians putting pressure on them, because the Federal Reserve does have a mandate to serve Congress in a way. So it's really a lot of pressure from politicians on the Federal Reserve that's causing them to be so hawkish over the last 6 months to a year. But I don't think that they're going to be getting the desired outcome that they're looking for, as inflation is still pretty high, and it looks like the economy is about to fall off a cliff. So having both of those happening at the same time is probably worst case scenario for getting reelected in 2024. So with that being said, I think there is a decent chance that everyone decides to flip the script before we even get a yield curve inversion. But I think worst case scenario, we get a yield curve inversion up here, and the Fed is forced to switch their policies a month into it, and things go back to the same atmosphere that we had from March of 2020 to April 1st of 2021. So back to the chart. We have this yellow line right here, which represents the trend line of a bump and run that we've been experiencing. This red line is where we experienced our bump. And this orange line is just a line of price action that I thought was pretty significant. It was also the point that we ended up breaking out of our trend line for the bump and run pattern. So I thought it was significant enough to at least chart on this chart that we're looking at now. Let me say that you have two different targets with a bump and run pattern. The first one is typically going to be where you get your first bump, which would be right here. As you can see, we have a consistent downtrend until right here, where you have a major decline. So that is considered a bump in a bump and run pattern. So this is the occurrence of the bump. So this would be our first target. And then the second target is where you begin your lead-in phase for the pattern, which would be the start of this trend line. And as you can see, this trend line would be a horizontal line that would take us over to above 3%. Although, as I was mentioning earlier, we do have this other blue trend line that dates back all the way to the 80s, which is pretty similar to the same spot that we had our lead-in start. So I believe that it's a better target to use this blue line as our secondary target. So with that, I think that does a pretty good job of putting the longer term into perspective. So let's take a second to dive into the details of the daily. So I actually decided to take us to a 4 hour where each candle represents 4 hours, just so we can get a little bit more price action and we can see it a little bit better what's going on in the moment. So you can see on a smaller time scale, we do have this descending channel that has built, and we did get a break out of that, and with today's FOMC meeting, we got a big exit to the upside, and it looks to be continuing its momentum, and the deltas are probably going to be pretty high, and I would expect this to take a nice little move up to this red line up here that we were looking at on our higher time perspective. So like we've been saying, we expect yields to continue having tailwinds and to continue going higher. We think that this is ultimately going to be I would not refer to it as a straw, but maybe the restaurant that falls on the camel and breaks its back. And if a restaurant falls on a camel, it's probably going to have more than just a broken back. You know, we're going to be pretty beat up by the time we get done with whatever this wants to do, in my opinion. But I think the short-term target should be this red line up here, as it is also our long-term target for our first target on the bump and run pattern that we are playing out. Keep in mind that these are yields, and this is a market that is highly influenced by politicians and central banks and policies and all that good stuff. So technical analysis doesn't have to work. You know, they could get a wild hair up their ass one day and make some crazy policy adjustment that completely disregards all technicals. So just keep that in mind. We have got a huge move in yields as of recent, so I think that we're probably going to need a little bit bigger of a cool down period at some point coming up. Like I said, this really doesn't have to do anything with technicals, so theoretically we don't need a cool down period. This can do whatever it wants. But I would think that that would be something that would be beneficial for the economy, because the delta on yields is definitely something that affects the economy in a big way. Because the higher the delta on the yield, the more money you have to come up with to pay the yield in a shorter amount of time. So you can see, even just since starting this video, this thing's already moving up pretty good. So my guess would be that we make it up to this red line and probably get a pretty good cool off at that point. But like I said, we don't have to get a cool off. So I would just say this would be the target for now, and probably just revisit it at that point to see how things are looking. But if we do want to get speculative, we can take a look up here just to see where that blue line is, because I think that's ultimately going to be our next price target afterwards. And when I say price target, I mean percentage target, but I think everyone understands what I mean. So yeah, you can see this blue line up here is about 2.7. So getting a move from 1.4 to 2.7 would be a huge move, and I would expect us to need at least a little bit of a cool down before we make that big of a move again. That is my opinion. I guess we will have to wait and see how things play out. I think that everything, the technicals, the macro, just anything you could pinpoint, suggests a move up to this red line in yields. Let's watch for that and then readdress things as things start to play out and unfold. So with that, I think that does a pretty good job of getting us caught up on where we're at on the US 2-year. So let's end the video there. Like this video to support the channel, comment below to let us know what you think about all this, and subscribe to the channel with the bell icon to receive notifications when we post content like this. As always, stay one move ahead. Have a wonderful day.